Hello everyone and welcome into the channel where I share my personal experiences and insights into the world of finance and investing. In this video, I'm going to go ahead and be discussing my call option trading strategy and how it helped me make profit in the first quarter of 2023 despite the volatile markets. So I don't often cover call options or just options in general. There are a couple times out there where I have done it in the past, but we are going to go ahead and do a first quarter update on all the call option premium that we have made. So we're going to go ahead and hit three different areas today. Number one, we're going to go ahead and cover the call option trading strategy, kind of going over understanding how I set my call options up. I do a brief overview of how the call option trading happens on the Metal Edge platform, because that is where I do my call options, and kind of going over the concept of the contract, the strike price, the expiration dates, and we'll go over a quick example here. Number two, we're going to go over some of the market trends for the first quarter of 2023. Kind of, whatever may have influenced the stock market out there. There's been a lot of things, but we'll cover some of the main highlights in the first quarter of 2023. And then number three, we're going to go into evaluating the overall performance of my call option portfolio. Whether I made profit, did it make profit. We'll go over, the breakdown of the premium that I sold for, the fees that were associated with it, the number of contracts I traded, and the overall return of each contract. So, it'll help kind of open up some of the challenges that I did have and lessons that I kind of learned during the first quarter. And if you guys have any comments or questions at any time during the video, just drop it into the comment section. Regardless if you're dropping multiple comments, it's always nice to have, individuals out there leaving comments or questions and stuff like that. So with that said, let's go ahead and get into the video. So I do have Merrill open. That is my primary platform for doing option trading. So we're going to do a quick overview of my call option strategy and kind of how I set up my contracts, set up my strike prices, expiration dates, and kind of go over it, right? So we're going to be using the S&P 500 SPY. This is the primary one that I collect within my taxable account. When inside of my Merrill Edge platform, I don't know if I've never done options on any other platform, but for me, it's pretty easy. I punch in the ticker symbol up here that I want to research or do options on. I click on research here. It gives you some general information up here, and when I click into it, it gives me a bit more information. I can go into the option chain. There it goes. Okay, so now we have these option contracts by dates. Now, this is one thing you can kind of look at. You can look at or near the money. You can look at all strike prices. Generally, I either go by date or the strike price itself. So here, for example, you'll see that the S&P 500 SPY, not the VU one, has contracts very often. Here we are. It's the 4th of April. It's Tuesday. There's Tuesday, Wednesday, Thursday, and then Friday is Good Friday, so the market's closed. And then again, next week, it opens back up on the 10th, and you have call options basically every single day. So that is one of the reasons that I set up my portfolio invested in the SPY, because my strategy does short-term or I can do long-term call options. And by having the availability to do a option in the middle of the week and not on a monthly basis, as so many other option or contracts allow you to only do, like VTI, VU, and a few others, they only allow you to do monthly options because of the the volume. There's not a lot of volume for them, so you don't have as many options. So going into here, right, the S&P 500 will go out, say, a week, for example. So today is the 4th of April. Let's go out to the 14th. So that would be a week and then some. So it gives you a quick snapshot. It shows you that the last price it was at, and then it shows you the options that are already in the money and some options that are out of the money. So out of the money just means that it's not currently priced at or below the current share price. So at $410.95, anything below is in the money already because it's already at a strike price that is being currently hit. And then out of the money is anything that's above the strike price or the current price. So for example, there's, the markets it's closed right now. So there's not going to be any sort of change here. But for example, if I wanted to set a strike price at $415, I would just click on the contract right here. You can see that it's currently trading for $2.94 per contract, times that by 100 shares. So this contract right here would net me $294 of premium per contract minus fees. There's going to be some fees in there. So here we can go ahead and select the option here. There's no easy, what I noticed here was that one thing that I would like to see on the platform, but this can be done like in a calculator or an external website, is that when you click on the option, it would be nice to see the percent difference between the current price and the option price that you're selecting. So 415, for example, I would like to see like a percent difference here. You can obviously do the percent difference by opening up a calculator and doing the new value of 415 minus the current value of 410.95 and dividing it by the old value, I believe, 410.95 times that by 100. So 415 is only a 0.98% difference. Plus 0.98%. Yeah, that seems pretty accurate. Okay, so to get to 115, it would only take the market really moving 1%. And that can be risky for some, right? So what you could do here is, okay, you're going to put, this is a 2-week contract. So in my examples, I often put in some, generally the market does not move more than 2% on a weekly basis. I was completely off last week. So in my example, I would do 410.95 at the beginning of the week, add about 2%. So my contract price, my strike price would be about 419. This is over, but you're adding 2%, which just generally doesn't happen on a week-to-week basis. There are going to be those instances where the market's going to move up 3-point-some%, but those are really rare. So 420 is going to be a good strike price to hit because we're kind of putting in a 2% difference on a weekly basis. So then I would come up here, click on all my strike prices. Go ahead and let this load because the 419 option isn't in here. Like I don't have that option. It's probably down here, but we just went ahead and opened up all of the strike prices. We click on 419. This is going to go into all the contracts at 419. And then I can just go in here and select the 17th of March. You can see here that premium is 179. That is not as much premium as that 294, right? But instead of a 0.98% wiggle room in the next week and a half, we're putting in basically a 2% wiggle room, right? So then we just go ahead and select the option here and select trade. And then inside of here, you're going to go ahead and fill out the rest of your options. We're going to go ahead and select a sell to open however many options that we're selling. So example, we're going to sell one option expiring on the 17th of April, 2023, about a week and a half out. Strike price is 419. And we have our last price of 179. Go ahead and punch in the current price that it's asking. So oftentimes, if you want it to happen immediately, you just want to give them what they're asking. So in this case, they're not really asking for anything because the markets are closed. So we put in 179. Generally, duration is just a day. And we can go ahead and see the breakdown down here. We're going to get 179 times 100 because there's 100 shares in each contract. So that's going to give us $179. And then our break even point is going to, it kind of tells us where we break even. We preview the order here. And so here we can see that there are some fees associated with this contract. there's a 1 cent SEC fee and a commission of 0.65. So very inexpensive. You can see that our total premium for this option contract would be $178.34. So this is putting in 2%. The risk would be that if the market were to move 2% between today's price and next week on Friday, 2% is actually quite a bit. And with as much as the market has moved recently, I'm not sure if the market will move another 2% to $419. Looking at the S&P 500 here, I can see that 419 isn't out of the realm of possibilities here. Back in February timeframe, the market did hit about 415 actually, 415, 416. So 419 would really be pushing that recent high. So you could actually bring in your call option down to 416 if you wanted to, but if you want to just have that wiggle room out there, we'll just leave it as it is. So going back over here, $419 is a pretty conservative strike price. It's way out of recent. The S&P 500 has not hit $419 this year. It's currently above its 50-day. It's currently above its 200-day. It's got that momentum right now, but it has been kind of slowing down recently. It's kind of, we gapped up in recent times. So we have a pretty good probability that we'll retrace and retest this 50-day. So if we're comfortable with our order, we would then submit our order. So that is sort of the call option strategy. Kind of went over the contract itself, finding different contracts on the platform. Every platform is going to be a little bit different. Your strike price is where you are willing to sell your shares at. So $419 is our strike price where we feel comfortable that it's a certain amount away from the current share price where we feel comfortable where it may not hit it if you don't want to sell your shares. And we have the expiration date, which again is on the 17th of April. If the share price does not hit $419, if it's anything below $419, this contract will expire completely worthless, and you will get to keep your premium of $178.34. If for whatever reason it passes over $419, you will be forced to sell your 100 shares at that share price of $419. So if it closes at $419.02, you will sell at $419. You'll still have made profit as if you were selling at $420.79 because of the options there. And then let's see here. Anything else we may have missed here in our understanding the call option and how I set these up? But I think we got a good hit on it. If you guys have any comments or questions on the call option strategy, let me know down in the comment section below. And then number two, going into the analyzing the recent market trends of the first quarter of 2023, there has been a ton of red. I didn't make every single thumbnail out there red. Because I honestly didn't make a lot of content in the first quarter of 2023. I'm really hoping to change that going into quarter two and so on. But there have been some interesting, conditions that have affected the market in the first quarter of 2023, such as interest rates. The Fed has came out and raised interest rates 0.25%. So they have begun to slow down because another factor is inflation. Inflation has been a little bit of an influence to the stock market. Inflation has been a little bit high. I believe it's actually 6 or 7% right now, but this leads to higher borrowing costs as companies are having to refinance at these higher rates. That makes their cost for business a lot higher. This drives up prices and reduces the overall ability for consumers to spend because prices are high. Consumers are able to afford less, they're buying less. But another thing that took place recently was the bank failures So right now, central banks, the Fed, everyone's kind of taking a look at the recent banking crisis and seeing how it could lead to more issues. Is raising rates going to affect, something there, as people are less likely to take on debt, to take on loans, and instead begin pulling money out of their savings, out of that uh, cash that they have on hand. So that's what happened, right? Those the big businesses, they didn't want to take on debt that 7 to 10% when they can use their cash reserves. So they go to the bank and they withdraw their cash to use for their business needs, and everybody starts doing this. And all of a sudden, you have these businesses that generally would take out a loan at 2%, 3%, but instead are choosing to use their cash on hand instead of taking on loans of 8 to 10%. So we had that recent bank failure, multiple banks failed, and everyone's kind of still cautious on that. So we also have global events taking place, kind of talking about some of the geopolitical tensions that we've had overseas between a couple countries overseas battling it out, and the BRICS movement, everyone kind of, the petrodollar, right? We just kind of discussed this. We went over recent market conditions with how individual countries are moving away from using the US dollar to buy oil. So they're now using yuan from China. So BRICS is the Brazil, Russia, India, China, and South Africa. And there's others that are beginning to trade externally to using the dollar. So I have seen a ton of videos posting up on YouTube going over all of that information. And we have the digital dollar that's getting rolled in. There's a whole lot of interesting events for the first quarter of 2023. So I'm actually really, really surprised to see the S&P 500 put on such a quick run up over the past couple weeks, especially where we were down here just maybe 2 to 4 weeks ago, down in that 380s, and then to be up at 410, a nearly $30 difference per share is pretty big. So that's basically all of the recent trends and market stuff that has happened in the first quarter. I'm sure there's more out there, but those are the main ones that I remember myself. So kind of going into number 3, evaluating the performance of my call options portfolio. So for this, I made a cheat sheet here for 2023. So at the very start of 2023, I had 3 call options that I opened up. These were for VTI, SPY, and VTI. So inside of my Roth IRA, I own 100 shares plus of VTI. Inside of an IRA, I hold 100 shares plus of VTI. And then inside of my taxable account, I hold 400 plus shares of SPY, just for reference. So on the 4th of January 2023, I went ahead and opened up a couple call options here. I hit my strike price on VTI at $200. In the future, I just wrote this up today, so in the future, I'm going to be locking in the current price. The next time that I do an option, I'm going to be locking in the current price of the ticker that I am doing a call option on. It's just that I made this today, so I don't have the current price that it was when I wrote the call option, but going forward, I'm going to have that information written down. So then I have my strike price. So I had a strike price of $200. This is back on the 4th of 2023. So if we go back here on the 4th of 2023 and we look at VTI, VTI was down here in the 190s. So 190s here, we had a strike price of 200. The difference isn't going to make any difference here. Expiration of 2/17, so February 17th, 23. One contract. It was sold for $3 per share. Times that by 100 shares. So we were able to collect $300 premium minus some fees. So our net premium from that option was $299.34. Now on the right hand side is my close. So all of this on the left hand side is my open price. And then once I close the option, we went ahead and recorded the information. So I did end up closing both of those VTI options on the 15th of February. So we opened them up on the 4th of January, and about a month and a half later, we ended up closing them. Now I did end up paying $7.50 per contract there to close it. So I was negative $750 in the bucket plus those fees. So I ended up losing $750.65 closing that option minus the initial premium. That netted me negative $451.31 per account. So each account took a loss there. And then SPY, I ended up closing that as well. I closed that back on April 1st. I don't believe that's correct. I think that I have to adjust that date. But I ended up closing that early. I did end up paying $6.86 per share, which netted me a closing. It cost me $2,746.60. So I did take a loss there. So I gained initially $1,625 in premium, but then because I closed it at a higher close price, I did lose $1,121.24. And then as of that point, you know, the market here, when I started closing these about midpoint February. So here we are, midpoint February. What happened on both of these indexes? It can't do that too easy. So here, right, let's go ahead and get rid of these. See if this does it. Nah, that doesn't do it. They're too different. So about the midpoint of February right here, the market just took off like a rocket out of nowhere. You know, we had been kind of low, but then we had that double bottom-ish, but a higher double bottom. And then again, it just kind of blew up out of the top. I was like, oh boy, is this running back up to all-time highs? So all-time highs would have been at 480. I did not want to miss out on that. So I ended up, that's why I was kind of closing them out. I didn't know what to do. I went ahead, just closed out the option just in case, for whatever reason, it just continued trending higher. But in that case, it did not trend higher. So just a few days later, you can see here that I waited it out a bit. You know, we had started those calls back on the 4th of January. I closed them about midpoint February. Oh, no, this has to be February 1st or something along those lines. I'll go back and take a look at that date after this video. But then in February here, we can see that we reopened our positions on SPY and VTI. We had a strike price of SPY at 415. We increased our strike price on VTI at 205. And we set our expiration dates a little bit further out. We opened 4 contracts on SPY, 1 on VTI per each. We sold these for $10.38 per contract for the SPYs and $11.63 for the VTIs. So that netted us there almost $6,500. But we did end up closing them not too soon after. So we can see here, we opened these on the 10th and 15th. We closed these. We closed the SPY on the 21st and we closed VTI on the 24th. They cost us $636 for the SPY, $670 for the VTI. And this ended up actually netting us the difference there. SPY gave us $1,602.70 in premium, and the VTI options each closed at $490 and some change there. So overall, that next premium, that next option there netted us $25.89 in total premium. So then we were completely closed there with VTI and SPY. So our next contracts, once again, on the 1st of March, we reopened our contracts with VTI and SPY. We reopened them exactly for the same price, 205 and 415. We set up our dates very similar, but it looks like we took a shorter expiration on VTI for 317.23, and our SPY contract looks like we redid it for the same expiration again. This time we did have a lower open price, so we opened the SPY at 325 per share. and VTI at 116 per share. So opening these contracts together, that netted us $1,527 in premium right off the bat. And then these were opened up on the 1st of March, right? And then on the 10th of March, so 9 days after, we closed all of these positions. VTI at that time was only worth 17 cents on the contract because on the 10th of March, let's go look. Yeah, 10th of March right here, you can see the market fell. It basically bottomed out. So I sold these premiums here on the 1st of March. So here we are, 1st of March right here. And 9 days in, the market fell off a cliff. So I was able to get nearly all of my premium really quickly just by closing the option. Here we closed it for 17 cents for VTI. That was negative 17. On the premium, we just paid $17.65 to close those contracts and $698.60 to close the contract on SPY. So those together netted us $793.17 just in that 9-day period. So that was a nice quick turnaround. And then right after, right, here we are on 310. We kind of waited a bit to see what's going to happen with this market. Is it going to continue downtrending? Was it going to continue uptrending? I just did not know. So I waited just a few days to kind of see what exactly is going to take place so I could refocus my, I don't want to make any rash decisions thinking that the market's going to, if it fell this fast, right, it's bound to recover just as fast, generally. So I didn't want to take any risk putting my strike price here while it was down at 384, at 390, and then having my contracts swept away, my shares swept away. So I waited a few days here, and I sold a call option on VTI with a strike price of 205 and a strike price of SPY at 400. And here we did the one option on VTI per account, 4 options on SPY, and we sold the VTIs for $1 and the SPYs for $125. So that netted us $696.07. So the VTI options are still open. So these options right here have an expiration for 4/21/23, and that is 3 weeks away right now. So these contracts are still open. The market is high at the moment, right? Current share price on VTI is 204.64. The current strike price is 205. The only the difference between the market needs to move is only 0.18%. If the market moves 0.18% positive and it closes, I have until the 21st of April for this to be at or below for this option to do whatever it needs to do. Right now, I'm just letting it ride out. I'm not going to be closing it at the moment. I'm going to go ahead and just let it sit because the momentum is slowing down right now for VTI. We put on this huge momentum running up, but it has to retrace. We have to retrace because the market did gap up a couple times. I believe we should retrace back down at least to the 50-day and just to retest it. When it does drop down to that 50-day, I do plan on closing my call options. If it falls down to 201 in that range, I will probably just close my call option, take whatever premium I get at that time. It should be net positive and just be out of it and just kind of wait, because right now this is unexpected movement for me. So I have to kind of refocus and just kind of wait to see what takes place. The SPY one, I did end up closing that out on the 30th of March because this was expiring on the 31st. The market had already skyrocketed, right? SPY had already blew way past my $400 strike price on the 30th. I think it was like a 406. So I went ahead and closed that call option on 330. I did have to pay $3.31 per share times the 100. That netted me negative $1,326.60. So that did put me negative $649 between the premium that I got up front and the premium, well, not the premium that I paid, but the amount I paid to close that option. So here I was negative $649. I did re-roll it forward. So on that same day that I closed that option, I reopened it. I set my strike price $5 higher at $405. Right now, the market needs to lose 1.45% before the 14th of April for this to be to expire worthless. I'm hoping that it does drop down. Again, same thing is currently happening. My strategy is still the same. If the SPY does retrace back down to 401, as I hope it does, who knows? Who knows, honestly? Then I will close that call option and wait. Right now, the markets are a lot more volatile than I had been expecting over the past week. And this whole momentum movement here from 430s, from 390s is unexpected. I did not expect this big of a movement to the upside. So I did sell that at $4.86 per contract times 100. That netted me, minus the fees, $1,941.38. So right now, I did make, this is still an active contract. It's not closed out, so these digits are just 0 at the moment. So I do have that full premium up front, but if I do have to close this and roll it forward, that's probably gonna, mark me negative once again. But we have until the 14th of April. So that's another week and a half, a week and a half for this to move at or below 405. But again, if it does move below and hit that 50-day, I do plan to close that contract out, take whatever premium is available at that time, and just kind of wait. So overall, for the first quarter of 2023, my net premium, the overall premium so far in first quarter 2023 is $3,318.99. So overall, that's a pretty good amount in the first quarter overall. So there were some challenges that came along with it, right? Market volatility, it's never going to do as you expect, even when you put in a good, healthy, conservative difference, like 2%, 3%. Generally, I put in a 2% difference on a 1 week basis because how often is it where the market moves 2% on a weekly basis, right? But that 3% gain last week, completely out of the water, how to roll it forward. So that was one of the challenges that kind of came with it. But overall, market volatility was in my favor. Oftentimes, I was able to use that volatility here to close early within 9 days and lock in a nearly 80%, 90% premium gain overall, right? So there's some really good opportunities out there. So overall, everything went good. Call option trading can be a very powerful tool for generating extra income on top of dividends, right? I have dividends in these portfolios, but premium is generating the extra income, and I'm able to profit from market volatility. One of the main things is just kind of understanding the basics of option contracts, analyzing current market trends, and just kind of taking a disciplined approach. Don't be too aggressive in your strike price. Put in that fluff, put in the expectation that the market maybe will do those 3-4% the fluctuations, right? If that was the case, if I knew that was going to happen more often, instead of instead of 405, I could have put in, let's see here, share price was like a 406, right? And I could have put in 3%. That would have put me at a strike price of 418. That would have been a 3% gain from that already high of 406, right? That was a high. That was already over the top here recently. And then putting in another bid there, just would have made it a bit more conservative. But yeah, don't be too risky in your investments. Stay disciplined. Make sure you're managing risk and just have fun with it. I think options is an interesting thing to have opened up. This could be lost, you know, some of it could be lost because we still have 3 open contracts, but it could end up positive. One of the things here, for example, this buy contract, this had an expiration of 421. My strike price here was 415. So this one right here, when I sold that call, netted me $4,149.30. So I'm going to see on the 21st, would this option, if I had left it be, would it have been, you know, would it have expired worthless and I just would have kept that premium? You know, sometimes you're being too volatile yourself. Like not volatile, but you're doing too much. You're trying to be too active with your contracts. You know, set it and forget it unless it's becoming risky. But in this case, I think I just kind of felt, hey, I can take nearly 50% of those profits, so I kind of closed it early. Maybe I was too aggressive. We'll find out later. But guys, that's going to be it. Thank you all for watching. Be sure to subscribe to my channel for more insights and updates on my call option journey. If you guys have any comments or questions, let me know down in the comment section below, and I will see you guys in the next video. Bye-bye.